Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Chris Engelbert, Founding Partner and Chief Investment Officer of Engelbert Investment Advisors, to discuss the buzz on social media about Roth IRAs and Roth options in a 401k. Chris, it's great to see you as always. Welcome back to Trade Talks. And when you sent over your talking points, I was not expecting to see that TikTok was a buzz around Roth IRAs.
Yeah, I mean, Jill, it's one of those things. I mean, we happen to be probably a very unusual RA that we are on all the different platforms, getting information, news, etc. And I hate to say it's kind of becoming my pet peeve, but social influencers are like running rampant out there, and they're talking about the Roth IRA and its magical features, how you can defer and not pay taxes, literally tax-free money, etc. And many of these people, if not all of them, very few are CFPs, registered investment advisors, etc. So they're giving this information, and a lot of times it's flawed. So I'm here today to try to, bust the myth of the Roth IRA and talk a little bit about how people should really use a Roth IRA or the 401k Roth option as well.
You know what? It's so interesting, Chris, when you see influencers promoting, let's call it skinny tea or different health supplements and so forth. There's been so much talk about regulation around that and disclosures. So when you think about your health, what about your financial health, right? Why is that not being regulated to a certain extent when you're making these claims, just like your personal health, about what's good for you, what's not, the promises that are being put out there? So I'm glad you brought this up, because there are a lot of myths around it, and people can get hurt if they're not researching this correctly.
Yeah, the one that just kind of put me over the edge this week is I saw a social influencer talk about a couple making $175,000 a year if they put $6,500 in a Roth IRA. How much they're going to have at the end. Well, here's the numbers. I mean, nobody's talking about, and again, they throw this information out there without any regards to people's tax rates, which are extremely important. So if you're a married couple, according to the 2023 IRS tax rates, your federal income tax is 18%. So if this couple would put money before tax, which we would strongly suggest, and get a 6% return and put the $6,500 in for 20 years, they would literally have $45,000 more in a before tax IRA or in the before tax option on their 401k. So again, we're getting a lot of these social influencers kind of like throwing this information out there and not really delving down into what people should do. So we have a rule at our shop, Jill, when it comes to Roth IRAs. We call it the 25 and 25 rule, so it's easy for people to remember. So if you're under the age of 25 and you're making less than $25,000 a year, your total taxable bracket from the federal standpoint is 11%. So if you could save $6,500 a year for a 20-year period of time, there would only be about a $13,500 difference between a before tax and an after-tax Roth. So for those people, it makes sense if you're in a low income tax bracket and you're not making a lot of money. But literally, for the majority of the people out there, you want the before tax option, from that standpoint. And again, that's my problem with social influencers, is they're not taking people's personal situations into account.
And it's challenging too, Chris, for people who have a lot of experience in the advisory business, such as yourself, because you want to be cognizant of the next gen of investors, the next gen of advisors, and they do in fact leverage online tools such as social media. So we don't, want to sound like, get off my lawn, old people, but I think it's also important that you provide that education as well. And I think that's a great catch on your part to call this out as it relates to Roth IRAs. Let's switch gears for a moment here and let's talk about technicals, because we've certainly seen somewhat of a composure shift in the market from the summer until where we are now. S&P 500, what are your thoughts around that from a technical perspective?
Yeah, we were, anybody that follows us, I've been saying ever since the end of July, would not be surprised to get a 5 to 7% pullback. We almost got a textbook 5% pullback from the end of July through the base in August. We've rallied a little bit off of that. I do think we're kind of setting up to be in a choppy market this fall. There's a lot of cross currents out there. We're going to go over the 10-year in a minute. but higher interest rates are kind of putting a damper on people's expectations. And so, looking into the third quarter earnings and the end of the year earnings, I would not be surprised to see some more consolidation, especially in the S&P 500.
Right. And speaking of that, let's take a look at the Nasdaq 100 because we know, breadth was an issue there. How much are the mega caps weighing on the index?
Yeah, really interesting what's happening here, though. Obviously there's this huge growth versus value, and growth, i.e., the Nasdaq has been on fire this year. It corrected a little bit more, but you can see from the chart it's actually recovering a little bit better. Interestingly enough, one of our models that we trade is a sector model, and it just traded this week. And guess what? The Nasdaq is broadening out. It put in a Nasdaq index in there. And so what's happening is everybody's like, hey, tech is leading the charge. It's only a handful of tech stocks. Turns out it's not a handful of tech stocks. There are more tech stocks that are leading, helping to keep this average up and actually, do better. So that's actually a more encouraging sign through the end of the year.
And let's talk about the Russell 2000. This almost seems like an evergreen comment when you and I come on the show together. Another failed attempt here. Yeah,
I hate to say that Russell 2000 is the redheaded stepchild, but we had a failed attempt. You can see it rallied right up to resistance, backed off again. What is encouraging, much like the broadening out in the Nasdaq, what's encouraging is that the Russell is able to seem to hold up, that much better. We'll see. We had a bad week. A bad day in the last week. On a pullback with the Russell, slowly rebuilding. Let's see how it's going to finish the year. Maybe this is the year. We'll see.
And finally, let's talk about oil. It hit your upside target this year, and it was quicker than I had expected.
Yeah, we've been a big bear on oil. We said, back a couple of months ago that we thought oil had bottomed. I said I would not be surprised. It's in the mid 80s range. It hit our target a little bit, higher than that. Oil can go a little bit higher, a little bit farther, faster than what people realize. So it could pop in the 90s. But I think, the rally for the year might be just about done in oil. And again, I think oil, like some of the major equity indexes, could have a sloppy third into fourth quarter, trading back and forth until we see really what's going on with the economy.
All right. And to wrap up here, speaking of the economy, what about the 10-year?
Yeah, this is what caused the equity indexes to pull back. We made another charge over 4.25% on the 10-year. Again, in our shop, we have a lot of conservative investors, and I've been saying, pounding the table. Hey, when you go to a barbecue and somebody's like, hey, what are you doing with your portfolio? You need to say, well, my advisor's talking about lengthening duration. Lengthening duration is just a fancy word for buying longer term bonds. The muni market right now in the 5 to 7, even 10-year range has a lot of value in it. And we're trying to talk to clients about saying, we haven't seen rates this high on the muni side in almost 10 years. There's a lot of value there, we feel, going forward.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.